Ever wondered how the US stock market rebounded from its months-long rut in 2023? Well, you're in for a treat. Picture this. It's November, and the markets are buzzing with optimism. The stocks, after languishing in a slump, are finally bouncing back. It's a sight to behold, like the first bloom after a harsh winter, a testament to the resilience of the market. The S&P 500, think of it as the heartbeat of the American stock market, made a stunning comeback, leaping a whopping 9%. It's like a runner once trailing, now sprinting towards the finish line, and it wasn't alone. The Nasdaq Composite, the tech-savvy cousin of the S&P 500, climbed even higher, boasting a rise of 10.7%. These were their best one-month gains since July of the previous year. Talk about a comeback. But what's even more interesting is that this wasn't just a local phenomenon. The global markets were also flexing their muscles. The MSCI All-Country World Index, a barometer of global stock performance, rose 9% in November. That's its best monthly performance since way back in April of 2020. But why the sudden turnaround? Well, it seems the market was betting on the Federal Reserve to ease off the gas pedal on raising interest rates. Investors were hopeful that the Fed, armed with data pointing towards slowing inflation, would manage to bring down inflation to its 2% target without triggering a recession. A soft landing, if you will. This optimism was further stirred by another inflation report, revealing that inflation had cooled down to its lowest level since spring of the previous year. The yield on the benchmark 10-year U.S. Treasury note, which had been at a 16-year high, fell, further fueling the quick recovery in stocks. Indeed, the U.S. stock market ended its best month of the year on a high note. But this is just the beginning of the story. There's much more to the tale of the 2023 stock rally rebound. What could be the reasons behind this rapid stock market recovery? Let's delve into the primary factors that contributed to this swift bounce back. The first significant factor is the declining Treasury yields from 16-year highs. Now, what does this mean? Well, when Treasury yields decline, it can make stocks more attractive in comparison. This shift can drive investors back into the stock market, bolstering its recovery. But the story doesn't end there. Investors aren't just passively watching these trends, they're actively placing their bets on future economic movements. One key area of focus has been the Federal Reserve's actions regarding interest rates. After a period of uncertainty and fears that the Federal Reserve would continue to raise interest rates, the tide seems to be turning. A series of data releases pointed to slower inflation, leading investors to bet that the Fed is done raising rates. This expectation is underpinned by the hope for what's known as a soft landing. This is the economic sweet spot where the Fed manages to bring down inflation to its 2% target without triggering a recession. These hopes were further bolstered by another inflation report. The Personal Consumption Expenditures Price Index, which is the central bank's preferred inflation gauge, showed that inflation cooled last month to its lowest level since spring of 2021. One more key factor to consider is the market breadth of this recovery. Unlike previous rallies dominated by a handful of tech giants, this rebound has seen a wider range of stocks climbing higher. This broad participation is a healthy sign and bodes well for the longevity of the rally. Finally, the year-end calendar effects also played a part in this recovery. As we move from late December into early January, stocks tend to gain, a phenomenon often referred to as the Santa Claus rally. So, when you look at the declining Treasury yields, the expectations around the Federal Reserve's actions, the broad market participation, and the year-end calendar effects, it becomes clear why the stock market has been able to recover so quickly. These factors combine to create a favorable climate for the stock market's swift recovery. Remember the Magnificent Seven. Let's talk about their role and the significant market breadth in this rally. The Magnificent Seven, a term coined for a group of mega-cap tech stocks, played a significant part in the market's gains earlier this year. They've been the reigning champs on Wall Street's scoreboard for quite some time. But this recent rally wasn't just their show. In fact, the comeback story of the stock market this year has been characterized by its wide reach. It wasn't just the tech giants flexing their muscles. The rise extended to a broader range of stocks, painting a picture of a rally that was more inclusive than exclusive. In recent weeks, there's been a resurgence in sectors of the market that had been long overlooked. We're talking about the underdogs here, the beaten-down financials, the small caps, and the cyclical stocks. They've been gaining traction and climbing higher, adding a new dimension to this rally. To truly understand the breadth of this market rally, let's consider a widely cited measure: the share of stocks in the S&P 500 trading above their 200-day moving averages. According to data from Cap Thesis, that figure stands at 60%. That's a significant majority of stocks trending upwards, reflecting the widespread nature of this rally. So what's the takeaway here? The rally has been far from a one-man show dominated by the Magnificent Seven. It's been a collective effort, a market-wide phenomenon. It's as if the entire market decided to roll up its sleeves and join the rally. This broad participation could bode well for the longevity of the rally. After all, a market rally that's driven by a diverse range of stocks, rather than a select few, is generally seen as a more sustainable and robust rally. So there you have it. The Magnificent Seven might have led the charge, but they certainly didn't do it alone. This rally wasn't just a one-man show, it was a collective effort, making the rebound even more remarkable. Have you heard about the Santa Claus rally? And what could be the potential risks ahead? Well, let's dive right in. The Santa Claus rally is a fascinating phenomenon where stocks tend to experience a surge from late December through early January. This rally is often attributed to the holiday-induced good cheer and the influx of investment bonuses. It's like Wall Street is riding on a sled of optimism, really. However, as much as we'd like to bask in the warmth of this holiday rally, we must also consider the potential risks that lie ahead. One such risk is the looming possibility of a recession. While the chances of a recession in the immediate future are low, some market strategists warn that these risks could increase as we move into 2024. Another potential risk is the timing of rate cuts. Investors and traders are currently pricing in rate cuts beginning early next year, according to the CME FedWatch tool. Yet, Wall Street might be getting a little ahead of itself. A soft landing, where inflation is brought down to its 2% target without triggering a recession, is not guaranteed. In the words of Richard Steinberg, chief market strategist at the Colony Group, "The only way I see a rally continuing is if the bond market behaves itself." This means that the rally's continuation heavily relies on the bond market's stability. So, while the Santa Claus rally is indeed a joyous phenomenon, it's important to remember that the financial markets are a complex system influenced by a multitude of factors. The market was indeed merry, but it's crucial to stay aware of the potential bumps on the road. As we dash through the snow of the holiday season, let's keep our eyes on the path ahead. After all, a savvy investor is always prepared for both the rallies and the risks. Let's summarize what we've learned about the 2023 stock rally. This year we saw the stock market rebound with vigor, breaking months of decline and marking the best month of gains for all major indexes. The S&P 500, NASDAQ Composite, and the Dow Jones Industrial Average all made impressive leaps, with the S&P 500 standing tall with a 19% increase this year. What fueled this quick recovery? We saw Treasury yields that had declined from 16-year highs playing a significant role. Investors, armed with data indicating slower inflation, placed their bets on the Federal Reserve ceasing to hike interest rates. The hope for a soft landing, where inflation is brought down to a 2% target without sparking a recession, also gained traction. Then we have the Magnificent Seven, a group of mega-cap tech stocks that were responsible for almost all the market's gains earlier this year. While they have continued to lead the pack, the rally has spread to encompass a broader range of stocks. Neglected sectors of the market, such as financials, small caps, and cyclical stocks, have been climbing higher in recent weeks. The market breadth, as measured by the share of stocks in the S&P 500 trading above their 200-day moving averages, is currently at 60%. This wide reach of the stock rebound bodes well for its longevity. But the rally wasn't all work and no play. The market also benefited from the so-called Santa Claus rally, a seasonal trend where stocks tend to rise from late December through early January, thanks to investment bonuses and holiday-induced good cheer. However, we should tread with caution. A recession, though not guaranteed, is not entirely off the cards. Some investors warn that Wall Street might be jumping the gun on timing rate cuts. The risks of a recession, while low in the coming months, could increase later in 2024. So that's the story of the 2023 stock rally. A journey of rebound, recovery, and resilience with a dash of holiday cheer and a sprinkle of caution for the road ahead.